Hello, this is Rich Dad. Today I will discuss three main topics: the current market situation and why Bitcoin is struggling, the unusual moves by Japan's Financial Services Agency, a complete summary of this month's interest rate cut event. Let's dive into these three topics in today's video, so let's get started. Short-term holders have a significant impact on Bitcoin's price. Since mid-August, they have sold 642,366 BTC, and the movements of these short-term holders heavily influence the market. Additionally, the proportion of stablecoins on exchanges, which could support buy orders, has decreased. For the price to rise, the amount of stablecoins available to absorb buying pressure needs to increase. However, since stablecoin reserves are decreasing, the strength to support buying pressure has naturally weakened. The number of active addresses, which gives insight into investor sentiment, helps us indirectly gauge how many people are trading Bitcoin. In 2024, the number of active addresses has sharply decreased, dropping below the starting point of Bitcoin's 2023 rally. However, unlike previous bear markets, Bitcoin's price is now moving sideways within a large range. This behavior suggests that the bull market hasn't ended. Despite the prolonged sideways movement, market participants seem to be quietly observing the market, driven by factors such as the potential impact of a Bitcoin spot ETF, the US presidential election, and expectations of interest rate cuts. If the number of active addresses starts to rise again, there's a strong chance that Bitcoin's price could also increase. Despite the ongoing price decline, on-chain data tracking exchange inflows and outflows shows that the amount of Bitcoin held on exchanges has been steadily decreasing. The red line here represents the amount of Bitcoin on exchanges, and during this period, someone has been accumulating a significant amount and withdrawing it off exchange. As I've mentioned repeatedly in previous videos, while retail investors continue to get shaken out, whale investors are steadily accumulating Bitcoin. This type of behavior is often seen before a bull market rather than during a bear market. So while the price drop may be difficult to endure, there's no need to feel overly anxious. Additionally, there was an article stating that Japan's Financial Services Agency is considering including cryptocurrencies as part of investment financial assets. According to the article, this move could have a significant impact on whether cryptocurrency ETFs will be approved for trading in Japan. Let me first explain Japan's Financial Services Agency. The FSA is a government agency established to ensure the stability and transparency of Japan's financial system, protect financial consumers, and promote the healthy development of the financial industry. Founded in 2000, the FSA is responsible for supervising and inspecting financial institutions, creating and enforcing financial regulations, and maintaining order in financial markets. The FSA plays a key role in maintaining and developing Japan's financial system through various functions. Regular reporting and audits are required to ensure transparency and protect customers. Additionally, asset management companies must provide accurate information to investors and manage conflicts in the investment decision-making process, which is part of the FSA's responsibilities. The FSA also collaborates with financial regulatory bodies from other countries to promote harmonization and cooperation in international financial regulations, contributing to global financial stability. By providing a stable and transparent financial environment, the FSA helps build trust with foreign investors and attract foreign investment. If Japan's Financial Services Agency, a key regulator in both the domestic and global financial markets, officially classifies Bitcoin or cryptocurrencies as financial assets, the implications could be significant. There's a high chance that Japanese investment institutions, which have not yet entered the market, will begin to do so. This could represent a significant positive catalyst for the market. This is because Japan's investment market is one of the largest in the world, with a massive scale. If Japanese institutions begin to enter the cryptocurrency market, the impact could be significant. Most of Japan's institutional investors' funds are heavily invested in stocks, real estate, and bonds, with a significantly smaller portion allocated to Bitcoin or cryptocurrencies compared to the United States. Looking at the current state of Japan's asset markets, as of the end of 2023, the stock market had a market capitalization of 800 trillion yen. Real estate was valued at 30 quadrillion yen. The bond market stood at 14 quadrillion yen, and the foreign exchange market was worth $1.3 trillion. If Japan's Financial Services Agency includes Bitcoin and cryptocurrencies as part of investment financial assets, a portion of the vast institutional funds in Japan's investment market could flow into the Bitcoin and cryptocurrency markets. Of course, this is just a hypothesis, but it seems like a very plausible scenario. Japan, facing an enormous national debt, may consider Bitcoin as part of a solution. Ultimately, it's only a matter of time before Japan approves and trades Bitcoin ETFs as well. Since the key event of an interest rate cut is scheduled for September 18th, we definitely need to discuss interest rates. According to a report by CNBC, central banks around the world are either starting or continuing to lower interest rates, signaling the end of an era of prolonged high borrowing costs. High borrowing costs refer to a situation where interest rates on loans or other financial products are high, making it expensive to borrow money. As these borrowing costs decrease, it could be a major positive for asset markets. Notably, the U.S. Federal Reserve, Fed, European Central Bank, ECB, and Bank of England, BOE, are expected to cut rates multiple times by the end of this year. These rate cuts reflect the central bank's commitment to continuing monetary easing policies, which are expected to positively impact the markets. Interest rate cuts are generally a policy tool used when the economy is showing signs of weakness. Experts suggest that when rates drop, economic growth tends to slow and corporate profits may decline. In such a scenario, asset markets can become volatile, meaning asset prices could fluctuate significantly. However, one of the main goals of interest rate cuts is to stimulate economic activity. In the long run, this policy can breathe life into the economy, positively impacting investment assets like stocks and cryptocurrencies. Most of you watching this video likely understand that when interest rates are cut, asset prices can rise. However, let me briefly explain the mechanism behind how interest rate cuts can lead to asset price increases. When interest rates are lowered, borrowing becomes cheaper, making it easier for businesses and consumers to take out loans. This leads to more spending and investment, which increases demand for goods, services, and assets. As money flows into the economy, asset prices like real estate, stocks, and cryptocurrencies tend to rise. Additionally, lower interest rates make traditional savings options, like bonds, less attractive, pushing investors towards higher return assets, which further drives up prices. When interest rates decrease, the value of future earnings becomes higher when evaluated in present terms. For example, in investments like cryptocurrencies, stocks, or real estate, future profits are worth more when discounted at lower rates. Lower interest rates reduce borrowing costs for people and businesses, making it cheaper to invest or expand operations. This leads to increased economic activity and higher corporate profits, ultimately driving up asset prices. Additionally, saving becomes less attractive compared to investing, as interest rates drop so low. People will likely turn to asset markets where higher returns are possible. This increases liquidity in the market. Moreover, improved economic sentiment creates expectations of future growth, encouraging more spending and investment. This optimism drives asset prices higher as people anticipate economic expansion. For these reasons, when interest rates are cut, asset prices tend to rise. The U.S. jobs report, set to be released on September 6th, is a key point of focus, especially with the upcoming interest rate decision. This report could be more influential than usual. If the labor market remains strong, the Federal Reserve may hesitate to cut rates. However, if job growth slows and unemployment rises, the Fed may be more likely to implement rate cuts to stimulate the economy. Let's take a closer look at some detailed data. In July, 90% of U.S. cities experienced an increase in unemployment compared to the previous year. In fact, 350 out of 389 major metropolitan areas saw a sharp rise in unemployment last month. Additionally, while some people in 8 large metropolitan areas with populations over 1 million found jobs in July 2024 compared to July 2019, the average weekly wages dropped in 43% of the 389 metropolitan areas. Notably, 5 out of the 8 highest paying regions, where the average weekly wage is over $1,400, saw wages decrease compared to the previous year. This data indicates that the U.S. labor market is weakening. Let's take a look at the unemployment rate data from the U.S. Bureau of Labor Statistics using a chart. The data set to be released this Friday will cover August, so the most recent available data we can see is for July. As you can see, during the COVID-19 pandemic, the unemployment rate hit an all-time high but then quickly declined. This was a period when the U.S. continuously lowered interest rates, keeping them near zero to stimulate the economy. In 2022, the unemployment rate reached its lowest point, but now it's starting to rise again, though not sharply. The unemployment rate is following an upward trend. Unless this Friday's report shows a significant drop, the likelihood of a rate cut increases. According to the FedWatch tool, the probability of a 0.25% rate cut in September is currently at 62%, while the chance of a 0.5% cut has risen to 38%, with the likelihood of the 0.5% cut steadily increasing. Let's take a look at previous data to see what might happen if a bigger step, like a 0.5% cut, is taken. In past instances of significant rate cuts, markets have often reacted with increased liquidity and a positive response in asset prices. However, large rate cuts can also signal concern about economic conditions, potentially leading to heightened volatility. By examining previous patterns, we can better understand what to expect if such a move occurs this time around. Let's take a look at the relationship between U.S. interest rate changes since 2015 and Bitcoin cycles. Many might assume that rates were lowered during the 2017 bull market, but from 2016 to 2017, 2017, interest rates were actually being raised, not lowered. Fast forward to the COVID-19 pandemic, this was a period when massive liquidity was injected into the economy to stimulate growth, leading to a significant rise in asset prices. However, in the aftermath, the Fed began raising rates to absorb the liquidity that had been pumped into the markets. Now let's compare this chart with the Bitcoin price chart to see how these two cycles align. If you look at 2017, despite rising interest rates, Bitcoin's price continued to climb. At that time, Bitcoin's market cap was much smaller, and the cryptocurrency market was far less developed, so it was less affected by interest rate hikes. Also, the pace of the rate increases was gradual, which allowed Bitcoin's price to rise steadily without much resistance. Then, during the COVID-19 pandemic, the interest rate dropped sharply from around 2% to 1%. If you look at how the market reacted, you'll notice that the legendary Corona pump coincided with the rate cut. After the rate was stabilized near zero, Bitcoin gradually rose, leading to a massive bull market. This period corresponds to this segment of the chart. When rates were hiked aggressively, Bitcoin's price plummeted. However, once rates were fixed at 5.25%, Bitcoin experienced another major rally. Now, with Bitcoin performing well even at the high 5.25% interest rate, if rates are gradually cut 7-8 times, as mentioned in the article, potentially bringing them down to around 3%, we could reasonably expect a massive bull market for Bitcoin and the cryptocurrency market as a whole. This graph shows the expected changes in the federal funds rate over the next 12 months. If the value is above zero, a rate hike is expected, and if it's below zero, a rate cut is anticipated. The numbers represent the expected number of rate cuts. Currently, the graph is at -8, meaning that 8 rate cuts are expected over the next 12 months. This could indicate that a major bull market may occur within that period. Now, with just 2 months left until the US presidential election, we can look at the past 2 elections where Bitcoin began to heat up before the election and then experience massive surges the following year. If a similar pattern plays out this time, we could potentially see Bitcoin double, triple, or even go beyond its current price next year. Here's a summary of today's discussion. The market is currently cooling within a large range, but this is an accumulation phase before a breakout. This is evident through the movements of whales. The door is opening for Japanese institutional funds to enter the Bitcoin and cryptocurrency markets. We hope to see these significant funds flow into the market soon. Interest rate cuts are becoming almost certain. However, instead of drastic cuts, we hope for a step-by-step approach that gradually revives the dormant crypto market. The legendary investor Warren Buffett once said, "Fear is your friend because it offers the opportunity to buy at a low price." Don't let fear drive you away. Use it as a chance to seize great opportunities. If you found today's video helpful, please subscribe, like, and leave a comment. Thank you.